Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As markets turn volatile and investors see their first significant drawdown since the COVID pandemic, today on the show, we talk about how you should look at judging your mutual fund portfolio, how you should ensure that it remains in sync with your goals, and whether you should be taking any sort of calls in terms of any changes. So how do you do a healthy review of the portfolio and keep your eye on your goals? To discuss this very interesting subject, we have with us Mr. D.P. Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund. And also we have with us Feroze Azeez, Deputy CEO at Anand Rathi Private Wealth. Thank you, gentlemen, so much for joining in. I must say that the market volatility is a mere coincidence. When we were thinking about the concept of this show, it was not at all linked to the current market fall. But in general, I think while we pay a lot of attention to what to buy, we don't discuss how to manage our investments and our money. So those are, some of the opening thoughts. And thank you very much for joining us on the show today.
Thank you.
Thank you, Surabhi.
So, DP sir, let's start with you. They say it's a bit of an art, it's a bit of a science, wealth management, money management, and even your portfolio management. What are your thoughts on the subject?
I think, see, as you said, this is absolutely a coincidence that market is volatile at this point of time. But the thing is, this is going to be an integral part of the market. This was supposed to be there, which was not coming for a long time. But the best thing about Indian investor is that the majority of the money is coming through SIPs. Yeah. So that is serving them, that is saving them a lot because they have entered at every level. So they are not burning their fingers at this point of time. The way it would have been had every point of money would have come through lump sum investments. So that is one of the best things. That is number one. And number two, when we look at the flows, overall flows, and the whole industry growth which we are looking at, this is majorly because of the mark-to-market gains which we had. Right. So we had a wonderful gain period, and it has come down. There's a drawdown. But one best thing in the whole story is that mutual fund industry per se will definitely come out to be winners. Oh, because the eye on quality, eye on other things. But see, when markets will fall down, every scheme will, the NAV will come down. Yeah. And this has to happen because the fortunes of a scheme cannot be different from the market. But when the recovery happens, the mutual fund will have a very, very sharp recovery than the market, because we have seen in the past also where the quality bias is not there, where the investments have been made without any research, without any quality check, without any management check, there people burn their fingers.
No, absolutely.
This time, I don't think for the last 2 years that people have gone into that category, whole hog. So good thing is there, and we hope whatever has happened in the market, whenever the market recovers, maybe another 4-5% from here downward, but then the recovery is going to be the same way. It's going to be a sharp recovery.
So, Mr. Singh, let me ask you one more thing. The mutual fund data came in just a day back, right? Yeah. And even in a falling market, equity funds have pulled in more than 41,000 crore rupees. The SIP, at least the gross number, SIP number is still running at 25,000 crores, an all-time high levels. So what has changed? What is leading to this different investor behavior, and what are you seeing in the funds?
See, one with the earlier used to be whenever market used to fall, people used to redeem. Now it's different. A mature behavior, when there's a fall in the market, people put in more money. Yeah. Because they want to average out whatever they have put in. And this is a mature behavior. That's why this is golden rule which have been getting known from beginning, that buy at low and sell at high. Right. Rather than the other way. The behavior used to be different. Yeah. Today it is the way it should be. So that's something. But we look at it, 25,000, 26,000 crore coming through this SIP route. Then another, say 7 to 8,000 from the institutional buyer, which is a structural money, including EPF, etc. If you put together, the whole industry has got not more than 8-9,000 crores. And with such a huge country, 8-9,000 crores is not a big amount.
Sure. All right. Feroze, before we get to the topic at hand, your thoughts, since we're discussing the current market volatility, how is this patch of a correction and investor behavior in this correction different from maybe what you saw 3-4 years ago?
I think, hi Surabhi, I think firstly, we discussed a few things. I was very intrigued by what Sir was also saying. One, we spoke of the fall. Yeah. There are two kinds of falls. Falls which are business usual business as usual, and the second nature of equity. See, 10% fall in the last 24 years of this century has happened every 10 months. Okay, so 10% fall pe surprise hona is surprising to me. Why should somebody be surprised on a 10% correction when that's the second nature of the beast?
Sure.
That's point one. What an investor needs to be worried about is catastrophic falls. 20, 25%.
Yeah.
If I put my money and see it down by 8, 10%, that was something which was known to me before I invest.
Because that's the nature of equity.
Correct.
Yeah.
If you consider it as an art, it might come as a surprise to you. If you consider it as a science, then you would have seen the data.
Now let's talk about the need to sort of nurture our funds and our investments, right? And to give it the constant attention time without being too fidgety all over the place. So first step is, a lot of investors simply will go back on the internet, they'll look at a fund and they'll look at the past returns. That's your first port of call. I want to ask you why that's not the most holistic or the best approach when you want to decide whether or not to invest. So
the first thing is that this way of looking at past 1 year, past 3 year return is definitely not the best way of putting money in these stocks, because you have to be, you should be weighing the philosophy of the fund, the credibility of the fund house, the credibility of the distributors who is doing a deep research on the portfolio. Today, if I go to Feroze to sell that why don't you look at my this A or B or C fund, he doesn't ask me what was the last 3 year return.
Yeah.
He will ask me what is the future lying in this fund.
Yeah.
Okay, if the future, I am able to convince him about the future, about the research, about the work I have done for the future next 3 years, that is the way it is. But unfortunately, that is not something which is on the public domain.
Yeah.
Public domain is 1 year, 3 year, every person who is do-it-yourself kind of person, he will look at that only and put his money. So if you ask me if I'll do that, I will never do that.
Yeah.
I will do for my money, I will see how the fund is positioned for the coming 3 years, coming 5 years, coming 2 years, how his economy is for the next 3-5 years. That is something which we have to do it gently, because this is the regulator mandated way of publication of the returns, etc.
Correct. Correct.
Okay, and second part, looking at this, if in 1 year some fund has not beaten the benchmark, it is generally being perceived as the underperforming the benchmark. And things don't happen the way you want it to happen.
Yeah.
If I am thinking of that market will fall down, it will not happen if I have thought today and tomorrow it will fall down. It may take 1 year to fall down. It will drawdown may happen 1 year down the line.
Sure.
And I was prepared for that 1 year. So my returns will be lesser than the market for that 1 year period.
Yeah. Yeah.
So the credibility, long-term database that how the things happen, how the drawdown happen, are going to be the guiding points, not the 1 year, 3 year return, previous returns.
That was such a great example and simple example that you gave us, that when a large AMC like SBI will go to Feroze and say, Feroze, hey, look at this new fund we're launching. Why don't you take it to your investors? Feroze is not going to ask you about, past returns, even if it is an ongoing fund. So let's actually take that point to Feroze. You tell us, Feroze, while, of course, I mean, it's a matter of great expertise. Selecting a fund is not a joke. But generally, when investors engage with their advisors or with their distributors, what are the additional factors that they should be aware of, that they should consider and check before taking the investment call?
Yes, there are two parts to this answer. One, I concur with what DP sir said. If you are a viewer and if you're a client or a research, you're an investor who's a retail investor who can't afford all the research or can't afford till some time a private banker who can do the research, looking at the fund house, looking at the fund house's pedigree, looking at the fund manager's stability, looking at how he has managed several funds, how all that information is available in the public domain. The two pieces of Anand Rathi's information, unfortunately not there in the public domain, but you bring it to public domain by shows. We've done so many shows and the output of that is available to all the CNBC-TV18 viewers. One thing which I swear by, two things I swear by, is called the target NAV.
Okay.
If a stock has a target, you see so many reports, TV18 tweets about this stock.
Stock price target, 12-month forward target.
So is it not logical that if a stock can have a target, a group of stocks, which is wrapped in a mutual fund, can have a target?
Wow.
Right? I was discussing this with somebody and he said, Stocks pay every time somebody was giving a stock recommendation. I was sitting as a spectator, another distributor was talking to him. As soon as he said a stock, he asked, what is the target? Then he said a mutual fund, he didn't ask for the target. So that is where it emanated from. So target NAV tells you what potential future is there. Not that it will always transpire, but it's a good hygiene check. That's point one. Point two, we do this analysis where we find out if the fund manager was on holiday, what would be the NAV. So we built some algorithms to figure out if Vasan was on a holiday. Okay, Vasan is the CIO. Would the investors be richer or poorer?
Okay, so that's a great starting point in terms of what all you need to consider beyond just past returns when you want to make that investment decision. We'll take a break and we come back and we talk about another important subject which is not often discussed. Exiting a fund. If you're sitting on great gains, should you exit, not exit, how to exit, when to exit? We'll address that after the break.
Let's talk money